Well, good evening and good morning and good day, depending on where you are around the world. Martin North and Harry Dent here for our live streaming event. Just to explain, we're in pre-show mode at the moment and will be for a couple of minutes, just to allow other people to come and join. We've got quite a few registered, so I hope they all come in. We've got Harry on standby, complete with his new book and slides to talk about, and we've got a bunch of things we want to talk about today, given the current state of the local economy here in Australia and also the global economy. So it's, I think, going to be a very interesting session. We've had a lot of interest in this particular seminar, and just to explain, we'll be making a recording real time as well, so we'll be able to put it up on the DFJ channel afterwards as well. So that's all good. So Harry at the moment is in mute mode, so I think he can hear me, but he's off listening to me at the moment. So I'm just going to fill in for one more moment. People never turn up on time, so we just give people a couple more minutes just to log in. Hopefully everybody's found their way into the channel. There is the facility to ask questions via the questions panel on the facility. So if you have questions that you can drop them in, I'll mention that a bit later as well. What we will do is basically go through the presentation bit first and then put the questions and answers towards the end of the show. That's the plan. Hopefully everything else will work just fine. So stand by, we're just going live. Well, hello and welcome to the Digital Finance Analytics and Harry Dent Show. Hello, Harry.
Yes, Martin. Can everybody hear me?
Yes. What time of day is over there?
It's 9 o'clock at night.
Okay, on Sunday evening.
On Sunday evening.
Okay,
yeah.
well, thank you for giving up some of your Sunday evening. It's really appreciated. It's Monday here, of course, and we've got a bit of a grey day. Thank you very much for your time. I'm really looking forward to this discussion. And we've already started to see some questions come through, so that's great. I guess just a couple of introductory remarks from me, and then we'll come across to you. We're in a very interesting situation here in Australia. There's a lot of negativity around in terms of the GDP number was down. We're seeing credit still rationing. We're seeing home prices sliding. We're seeing the broader economy now starting to react as well with terms of negative retail news as well as negative construction news. So it looks to me from a local perspective as though the forward grind down is beginning to gain momentum. And of course, over the weekend, we saw the US yield curve invert. We saw some of the change of strategy from the Fed quite recently. So we're in a rather interesting situation. Then, of course, we've got things like what's going on with China and their stimulation there of their economy. We've got Europe and what's going on over there, particularly with more QE and all of that sort of stuff. Brexit. So we are in a rather uncertain time. So I think it's a really good time to have a conversation about what's going on, what might play out. And I think one of the interesting questions which I get a lot, which I can't directly answer, is what should people be thinking about in terms of their own financial situation, and what preparations should they be making? So given the uncertainty that's around the place, I think that will be a good place to try and end up as we go through the conversation, Harry. So with that introduction, let's go across to you. And I know that you've been doing a lot of work recently. I know you've got some new ideas coming there as well. So it'll be good to start sharing those and then take the conversation forward from there. So across to you, Harry.
Thank you, Martin. Very happy to be here tonight. Looking forward to coming back to Australia. I do get terrible jet lag when I come there. So, I just take a couple shots of espresso and go ahead. I want to let people know I'm going to give a short presentation tonight, kind of like an overview of some important points, but I'm going to give a very in-depth presentation. So you're going to get a couple hours from me in the morning, hour, and plenty of Q&A in the afternoon. Every day I'm there. I'm going to be there, from late April. I start on 24th in Auckland, end up in Brisbane on May 2nd, and I'll give you the schedule later. So again, there's going to be plenty of information, so you will see everything I know and find important. I'm going to bring a lot of slides in from Martin. Martin is the best analyst in Australia, hands down. He's the only person I work with directly because he does real good objective analysis, which is hard to find in the world today. Everybody's got kind of a view or point of view or some political angle or some angle. Martin and I don't. We just look for the truth. And then, I started my whole work in demographics. That's how I got known. Late 80s and early 90s. My first two books were just about, hey, demographic trends. This giant baby boom is coming at Australia and the US and Europe. And guess what? Japan was the country that had already seen their boom and bubble. And we said Japan in 1989 was going to collapse in the 90s, and the US and Europe and Australia and New Zealand were going to have the greatest booms in history. And it happened. But I've since, and I'll show, I've had to add some cycles. The demographic cycles are important. They are very fundamental. Nobody else in the economic world seems to understand how important people are. And one of the reasons for that is for most of history, the everyday person wasn't that important to the economy because they didn't make much money. The first middle-class generation came after World War II. I call them the Bob Hope generation. First generation to make strong incomes. And then they were followed by the massive baby boom generation, which I learned about early on because I was consulting to new ventures in California, and they were appealing to young baby boomers and new trends in the early 80s when I was really consulting and studying demographics and stuff. I saw the baby boom and said, oh my God, I got to learn everything about these people. And I know, cradle to grave what they do. And there's always something booming because of them. And there's going to be a lot of late stage industries that are going to continue to do well in places like the US and Australia. But I'll also show Australia demographically is the strongest country in the developed world. Now I'll show there's a big difference between the trends in emerging countries that are younger, have stronger demographics, and are still urbanizing, and the developed countries. But Australia has the strongest in the world because of your quantity and quality of immigration. And the US is more like a country that has a millennial generation that comes up to the size of the baby boom in numbers and need for housing and automobiles and stuff like that, but doesn't exceed it like Australia does. So I'll look at all of that. But I just want to start. My breakthrough indicator, if you look at the first slide here, was what I call the spending wave, or the generational spending wave. And it's so simple, economists still can't get how simple the economy is at a summary level. It's just the birth index in the United States, which I adjust for immigrants, and I do so in Australia as well. And it's very important when countries like Australia and the United States have strong immigration, especially Australia. But it's just the immigration adjusted birth index. In other words, I will put immigrants who come into the country, in the case of the US, legal and illegal, in as if they were born here, because I can do that with a simple computer model because there's a bell curve of immigrants. So that's what I have in this first slide. The blue line is just a 46-year lag. That is when the average person in the United States spends the most money in their entire lifetime. Now, for affluent people, it's more like early to mid 50s. Australia, Japan, in your neck of the woods, 47 tends to be the peak, just a little bit later than the United States. But I just move forward for the peak in spending, and you can see, you can tell when a country, and of course the United States is the largest economy and country in the world, when we're going to boom and bust decades in advance. I mean, one simple indicator. And that indicator told me that the 90s was going to be the strongest decade of the boom that started in 1983. And that boom peaked with baby boom spending in late 2007. That's something I predicted in 1989 in my first book and reiterated with the great boom ahead in 1993. We saw the boom coming. We saw Japan bursting. Again, I always say, why don't economists study Japan? Japan had their baby boom much earlier. Their peak births were 42 and 49 on both sides of World War II. They had their big boom early. They had their real estate bubble, just like we've had and earlier, and it peaked and it burst. And real estate prices never came back in Japan, if people haven't noticed, because now there's a new phenomenon in real estate where there's the buyers are people in their early 40s, peak buyers, but when people die, they become sellers because real estate lasts forever. So Japan never even bounced, which taught me something unique about real estate. I don't just lag for peak spending in real estate at 41 or 42, say in Australia, I have to subtract the dyers who become sellers. But here's the spending wave in the United States. Greatest boom in history, and we've been in a downtrend demographically, and most countries in the developed world, Europe, and have been in a downtrend as well. Europe just peaked 3 years after the US. Australia peaks about the same time, except I'll show you don't peak because of your immigrants. But the US and most countries have been in a downtrend. This downtrend will bottom out between 2020 and 2023. That's going to be the worst of demographic trends ahead. And what governments have basically been doing around the world, our central banks and Japan and Europe, the ECB and everybody else, have been printing money to fill this void. That's what they've simply been doing. The economy slowed down and they said, oh my gosh, with all the debt in the world, and we got way more debt than you do, and Europe's bad and Japan's the worst. All this debt would have unraveled and caused a depression-like crisis, which was starting in 2008, if it hadn't have been for $12 trillion and still rising of government printing. So that, here's my chart in the past. Now here's the second version of this. Here's what happened after quantitative easing, after governments decide to print trillions of dollars a year globally. And that money goes into the financial systems. And most importantly, the single cause of stock buying in the world has been corporations buying their own stocks. Institutional investors have net been selling. Retail investors have been neutral. Foreign investors have been more neutral. It's all been corporations buying back their own stock. And so reducing the float. And that's what you have here in this chart. Compared to this fundamental indicator, which is the best one I've ever found, and I can do for any country in the world, and I can do it globally and everything else, that stocks are about over 100% overvalued from where they should be on this blue line. And that's exactly how much earnings per share have grown faster than earnings because of companies buying back their own stocks. So two things going on in the world today. Governments are issuing record debt, not so much in Australia, but everybody else in Europe and Japan, especially US, record debt, and they're buying their own government debt to both, make a market for so much debt, but more importantly, to push down, to suppress interest rates so they don't have to pay the high cost of servicing that debt. That's how Japan has 260% debt to GDP, just government debt, but it's paying almost zero interest on that because they put interest rates to zero adjusted for inflation. That this is the best indicators. And again, I can look anywhere around the world. Now, if I look at Australia, this is the really good news for you. Yes, you've got a dip. You can see this graph. This is your spending wave with immigrants included in the global data I have on this. You guys have a strong surge after this brief downturn into 2035, and then you kind of back off for about 10 years modestly, and then you just keep going up. I mean, all the way to that peak in 2065 out there, that's with your current people and immigrants. Now, I'm assuming immigrants are going to keep coming in, but all the way out to 2065, this cake is already baked. This is the strongest demographic chart in the developed world. There's only 6 small developed countries, Australia, New Zealand, Singapore, Sweden, Norway, and Israel, that have this pod, that have generations, the millennial generations, the generation to follow are larger than the baby boom. That is not the US and the UK, and a lot of those countries they're similar. And then most countries in Europe, Southern Europe, East Europe, Russia, have declining demographics, and the Japanese after 2020 are going to see further declines in demographics. So the developed world is slowing, and Australia is a big exception to that. So that's the good news for you. I mean, the bad news is you have one of the greatest real estate bubbles in the world. Now, the next chart is New Zealand. You can see New Zealand's millennial generation goes to new heights into 2040. And then it kind of plateaus out. That's just still stronger. There aren't many countries that have that. But again, note, because of even higher foreign immigration, largely Asian. And by the way, nobody in the world ever complains about Asian immigrants, okay? We get all types of complaints about Mexican immigrants, the United States, and everybody else, not Asian immigrants. But New Zealand still has upward demographics into 2040. Again, one of only 6 countries in the world. So again, you guys demographically are in good shape, even though there is some near-term slowing, and then there'll be some off and on down the road. Now, real quickly, this is just another summary graph. If I look at the red line here in the next slide, the developed countries altogether, and I define these as countries with 25,000 or higher GDP per capita adjusted for living standards and living costs. That's where I draw the line. You could draw at 20, you could draw at 30. I found 25 to be the best. The developed world, as I said, if you take us all together, well, we pretty much go sideways into 2035 or so, and then slow down for decades to follow. It's the emerging country, the black line you see here, where all the demographic growth is going to be in the world. Again, with the exception of countries like Australia and New Zealand that have stronger immigration. So where do investors and businesses invest? Well, you can, Australia is going to be a place you can invest after this crash I'm going to forecast, and it's going to be a big one. And people know I've been forecasting this for a long time, real estate included. But it's going to be places like Australia, but more important, the emerging world. And the best parts, when I look at urbanization and productivity rates in the emerging world, and that's how they get rich, demographics plus urbanizing, where you get 3 times the GDP per capita out of city people as you do rural. The best places are going to be India, #1, and Southeast Asia, #2. All the countries on your doorstep, from Indonesia to Myanmar, and all the 6 or 7 different countries. East Asia is going to be slowing with the developed countries. China's workforce has already peaked in 2011, and more important, their migrant workers are going back to the rural areas because they can't afford to live in the overpriced, overcrowded, oversmogged, over-trafficked cities. And then they get paid less than the average person and get treated like second-class citizens, pretty much almost like illegal immigrants in the United States. So China's model has been what I call it, pardon my French, build shit for nobody. They got 22% empty condos and houses in urban areas. So China is the only emerging country that does not have demographic growth. They still have urbanization potential. But again, for the decades down the road, India is going to be the next China. And Southeast Asia is going to be the second best part of the world. Those are your best export markets. Now, real quickly, I started with demographics in 1988. I came up with the spending wave. That's what allowed me to see the incredible boom that nobody saw. That's what allowed me to see the collapse of Japan, which nobody saw. One simple indicator. And that indicator, I also had an inflation indicator for people entering the workforce. Young people cause inflation because they're expensive to raise and expensive to initially incorporate in the workforce. Then they become productive workers, spending, raising families, doing all this great stuff that drives the economy. What I've had to do over 30 years, and this is what the best scientists do. I tell people all the time, I don't look to economists for cycles. They're terrible cycle people. They don't do good research. They're not objective like people like Martin North and myself. And so I look to scientists. Scientists can project so many things so far out, you won't even believe it. The best cycle guy in the world is a guy named Milankovitch, a Russian, who can predict climate cycles, tens of thousands of years in advance accurately. He has a hierarchy of 3 cycles. Well, you see in this chart here, I have 3 longer term cycles, an innovation technology cycle, which is the most powerful on top. Then my blue line, the demographic cycles that boom and bust about every 40 years. So that technology cycle, and believe me, and I've done my own work on this, steamships, railroads, automobiles, and electrical appliances, and now the internet and broadband. These things all peak 45 years from each other. 1875 for steamships, 1920 for railroads, 1965 for automobiles and electrical appliances and TVs and all that sort of stuff. And of course, recently 2010 for the internet and broadband and all this sort of stuff. These things are what drive the economy. I also had to add a 35-year geopolitical cycle when 9/11 hit. My biggest error in forecasting, I was right about the boom continuing after the crash. I was right about the tech crash back then, but I saw the Dow going to 35,000 in the last boom. But I wasn't counting for the fact that the geopolitical cycles were going to shift very negative. And that's what they did. 9/11 forward, one terrorist event after the next. And now you got white supremacists, terrorizing the terrorists. And, it's civil wars around the world, especially in the Middle East. We've been in a difficult scenario. That I found historically. The reason this is important, I had to add this red 35-year cycle up and down, about 17, 18 years up, 17, 18 years down, is because stocks do 50% worse. They're valued 50% less on average at the bottom of a geopolitical cycle versus the top. So it is important, especially for stocks. And then at the bottom, I have a 10-year boom bust cycle, but it's not really 10 years. Ned Davis is famous in the United States for his decennial cycle, but it has failed in recent years because he doesn't realize that the real cause of that is sunspot cycles. Sunspot cycles average 10 years in the last century, 11 years if you go back 500 years, but they can be 8 to 14. Gravitational pull of larger planets on the sun. The point is scientists can predict sunspot cycles, and the last one was the longest. It was a 14-year cycle. So again, the normal Ned Davis 10-year cycle hasn't worked recently. Well, my cycles work because I find the real cause. So I can project demographics anywhere in the world, and I look to scientists to predict when sunspot cycles are going to peak. And this present sunspot cycle we're in will bottom around late 2020. So that 88% of recessions and stock crashes happen in the down sunspot cycles, the best correlation you'll find for anything. And 100% of major recessions and financial crises and depressions, like I'm looking at, occur in these down sunspot cycles. So I get a lot of flack for using this. I tell people, ignore this at your peril. It's the best cycle I found since the generation cycles back in 1988. Point is, all of these cycles together point down like they did in the early 30s and the mid 70s, the worst crashes between 2020 and 22. And then they start turning up one by one. So we're going to have this great crash. It should happen between 2020 and 22, and that's just right around the corner. Now, I'm going to show you another important cycle. My co-author on 0 Hour, the book I showed on the first slide, Andy Pancholi, I learned early on that it took 2 generation cycles to get a 4-season spring boom, summer inflation, fall bubble boom, and winter deflationary cycles. 4 seasons of our economy. And that's important, not just because of the booms and busts. It's important because each season requires a different strategy as a business manager or entrepreneur and as investments. Everybody wants to come up. Ray Dalio, the successful hedge fund manager. And you know what happens? As soon as these guys have 6 or 7 good years, now they're an expert on everything, like Warren Buffett. Warren Buffett doesn't know shit about the economy, to tell you the truth. He's just a damn good value investor. Well, Ray Dalio is trying to come up with an all-season model. That is terrible because it means you're going to underperform in every season. Why would you want to buy bonds in the spring boom and the inflation summer season when interest rates just go up and bonds go down? Why would you want to hold stocks from 1968 to 82 when demographic trends are pointing down, or 2008 to 2023 when they're pointing down for a long period of time? So different strategies for different seasons. We have been in the winter season. And I know this is going to be a surprise to some people with the stock market at new all-time highs, and I'm going to look at that in a minute. But real GDP in the United States, real GDP has been cumulative since the peak in 2007, which I predicted decades before it happened, and now 2018 through 2018, 11 years, is this 19%, and the same trend from 1929 at the top of that big bubble and the burst and the Great Depression into 1940 was also 20%. We've actually done 1% worse. We've had a winter season. It's just we've had a stock bubble at the same time. Now, again, I showed earlier in the chart how much stocks are overvalued just because of quantitative easing and companies being able to cheaply buy back their own stocks, which is cheating. Governments issuing record debt, as I said, and in suppressing interest rates to make that a more affordable to float, and companies buying their own stocks. This is the greatest bullshit boom in history. In the 90s, that was a real bubble. That was a bubble, but it was also all of my cycles were booming together at the strongest. Technology was cooking. Internet was moving mainstream. Boomers were spending at the fastest rates. Geopolitical cycle was favorable from 1983 to 2000. Nothing of major went wrong. And of course, the sunspot cycles were favorable at the best times, like 95 to 2000. So again, these cycles tell me decades in advance and decades back what has happened, what will happen. And it took a hierarchy of all four of them, three of them for the key long-term cycles, like those climate cycles that work so well, and then this 10-year cycle to refine when you're more likely to see booms and crashes. Now, but here's the biggie. What Andy Pancholi taught me even more so, yeah, I realized it took 2 generation booms and busts to create a 4-season cycle. And 4-season cycles always tell you, oh, that's the most fundamental cycle when you can break it down into that. Well, Andy Pancholi taught me all of his key cycles. When you double them, they're more powerful. He always told me his most powerful cycle was 45-year and doubled at 90-year. Well, that's when I finally looked back in his cycles. I have to have a reason for a cycle and found that technology correlation. Now, that's exactly every 45 years, new technologies come along, surge in the mainstream, and then peak clusters of technologies. Well, every 90 years since the Industrial Revolution, when I say Harry met Sally, when we had democracy for the first time and free market capitalism. You know, in 1776, if I had to put that cycle, major cycle down, 1776, Adam Smith published The Wealth of Nations, the first real book explaining free market capitalism. The steam engine was perfected and patented, and the Declaration of Independence, the advent of democracy, that was signed, all in 1 year. Ever since then, we've seen the biggest bubbles and the biggest resets on this double technology cycle every 90 years. 1837 to 42 was the greatest reset in U.S. history before the Great Depression. There was a bubble in Midwest real estate as governments encouraged people with cheap land and easy loans to move westward. In the canal bubble opened up the Great Lakes to the Atlantic Ocean. Chicago became an overnight new New York. The greatest real estate boom and bubble in U.S. history, and the biggest crash, stocks as well. And then, of course, 29 to 32 was the next great reset. We are right on. Late this year, late 2019, will be the 90th anniversary since the peak in September 1929 and the 89% crash, which ended up being the worst stock crash and the deepest depression in all of U.S. history. We've got another such cycle coming up. And guess what? Between now and then, this bubble's probably going to get even steeper. That's one of my secret forecasts I'm going to show when I'm out there, that we could see a NASDAQ of 10,000 within a year before this bubble burst, because I know bubbles. I'm going to give you a lot of information. I'm going to spend a lot of time on bubbles. I've not only added all these cycles over the years, but I've become an expert since 2000 on bubbles because we are in such a bubble era. Bubbles are not black swans. They're not unexpected. There's nothing easier to see than a bubble. They're exponential. They crash twice as fast and hard as they go up exponentially. The first crash is 40% on average in 2 to 3 months. I know everything about bubbles, where we are in a bubble cycle. The only thing that's hard to predict is exactly when it's going to peak, but you know when you're in that final, I call it orgasmic stage, and then I can tell you what the downside is. And I'm telling you, it's 80 to 90% for the stock market. Now, real quick, real estate is the biggest topic where you're at for obvious reasons. Sydney and Melbourne are, Perth crashed first because of the commodity crisis, but of course, Sydney and Melbourne more from overvaluation. Outside of Hong Kong in the developed world and outside of China in the emerging world, Sydney, Melbourne, and Auckland are the most overvalued cities in the developed world. 12, 14 times income. Hong Kong is 39. It's just crazy. China cities are typically 14 to 20 times income. Unbelievable overvaluation. Well, I have bubble models now for stocks and real estate. And here's my bubble model for Sydney, just as the most extreme example. In Melbourne would be pretty similar. This says that we could have a 59% crash in real estate over the next several years. 59%. Now, I know a lot of economists are saying, oh, yeah, it's down 10 or so, and it'll be down another 10. No, bubbles don't crash like that. Bubbles burst in stocks, 70 to 90%, in real estate, typically 40 to 60%. And you have one of the most extreme ones. Real estate does not crash back to a full bubble origin like stocks do. They do about 85% of that. I'm saying Sydney could go down 50 to 60%. And if you look at this red line here, just if I was looking at this as a chart and knew nothing about it, I'd say when this thing pops, you go back to prices where they were 2004 to 2008. That is 60% down. So nobody sees that coming. Martin North's the only one telling people it's going to be 40% plus. And he's actually correct. I have some other models I'll show you. Stocks are overvalued. I mean, real estate's overvalued by 40%. It's just when they crash, they overdo it on the upside and overdo it on the downside. But Martin is exactly right. 40% is the level of overvaluation. And nobody in Australia is telling you it's going to go down 40, 50, or 60%. Well, Martin and I are telling you that, and you better get ready, and it's starting to happen. And by the way, in 2006, real estate led our crisis and our GFC, which we had much worse than you. Real estate peaked in early 2006, and the home construction index, which is one of my leading indicators I'll show you, was already down 60% when the stock market peaked in late 2007. Real estate led the crisis, and that's happening in Australia today. You're going to be in a full-blown recession within a year by that indicator, and real estate is going to go down, as I said, a lot more than the 10, 12, or 14% you've seen it go down in the best parts of Sydney and Melbourne. Now, this is just one of Martin's slides, and then Martin shares his information with me, so I'm going to be giving you a lot of his information to back up everything because you have to know the specifics in Australia. This is just one I choose. Mortgage stress is accelerating. It's spiking. This is the key sign and I've been saying this, and people know that, and I've gotten a lot of crap for that. I've been saying, despite your strong demographics, despite your low government debt and a lot of positive things in Australia, you have one of the biggest real estate bubbles in the world, and it will burst. All bubbles burst, period. There's been people in Australia say, Harry, you don't understand Australian real estate. And I'm like, you know what you can go do to yourselves. There's no two more similar markets than California and Australia. And I lived in California for 22 years, and I've seen the bubbles there. California and Australia are attractive climates, great places where people like to live, and yet very limited land for development because of the desert there and the mountains and the oceans and all this sort of stuff. Very similar markets. So I do understand Australian real estate. It's why your bubble has been so strong, but bubbles do burst. And here's the bubble of all bubbles, Shanghai. And of course, Beijing, Shenzhen, I mean, all the major cities. First tier cities the most, but even the second and third tier cities have bubbled up, especially recently. Shanghai, now we're good. Sydney real estate since 2000 went up 3.3 times, 230%. That's a lot for real estate. Real estate doesn't usually go up like that. Stocks do. China's gone up 8.7 times since 2001. This is the craziest bubble in history, and it's happening in an economy where 22% of these condos are empty. Chinese investors will buy empty real estate, let it sit empty, don't rent it out, because there's not a rental market in Shanghai, in China, in cities, because if you're a man and you don't own something, no matter how small, you don't have a chance of getting laid or getting married. 89% of people own in China, even if it's 5 families owning one condo together. China's the biggest bubble in history. It's being totally stoked by the government. They basically guarantee loans down to the local communist parties, and then those local communist cronies give out these loans and debt to developers who just build shit for nobody, and nobody cares that they're empty. That makes the bubble even worse. So China's the biggest bubble in the world. You're second, and China is going to impact your whole region. It's going to be the biggest. Here's what my model says: 78% potential for decline in Shanghai, in the major cities in China. 78%. And Chinese, you know how much net worth they have in real estate? 75% of their net worth is in real estate. It's 60-some% in Australia because you guys are so overvalued, and it's only 30%, little less than 30% in the US. And you saw how big a crisis we had when real estate collapsed in 2006 to 2012. Now, and finally, I have to argue, if I have to listen to one more pea-brain economist say, oh, this isn't a bubble because. Look, bubbles are obvious. And again, I'm going to show you bubble models. I'm going to show you a bubble, nothing more predictable than bubbles in every stage of them. And nothing more obvious. It's like a 10-foot wave rolling on the beach in Australia. How can people miss this? Well, look at the 4 bubbles we've had. We're in what I call the fall bubble boom season. That was from 1983 to 2007 when the baby boomers were in a spending cycle. 87 minor bubble crash, 40%. Most of that in 2 days, most of it in 2 weeks. Then we had the tech bubble. Everybody agreed that was a bubble in the 90s. Well, then it crashed. Well, then we had a bubble in 2007 and it crashed and went lower. But look at this bubble. How can somebody say this isn't a bubble? And look at this. The reason people and economists and everybody doesn't see bubbles is everybody's high. Everybody's getting a bonus. Their house is going up 20, 25% a year instead of the normal inflation rate, which they go up with 3%. Stocks, instead of going up the normal 7% adjusted for inflation, are going up 20, 25, 30% a year. Everybody's getting a free lunch. Everybody's high. People don't want to see the bubble. They don't want to see this going to burst. So they go into denial. My projection for the Dow, first of all, that's going to go to 33,000 likely by the end of this year for this bubble's over, because it's still running and it still hasn't shown. You don't know a bubble's over until it crashes at 40% in the first couple of months, 2 to 3 months. But I can tell whether the trajectory in the January 2018 crash and in the recent one in the December of last year were not showing the trajectory to say that the bubble's over and this is a bubble crash. So this bubble still wants to roll, and it is rolling. It's already, I think we've already seen the first wave up. So Dow could go to 33,000, and then my target, my minimum target is the bottom trend line through these bottoms, 5,000 Dow in 2022 when my cycles are at the worst. And if it goes back to the bubble origin in late 94, which is the most likely, it would be 3,800. We're talking an 85 to 90% crash in the Dow, and of course, tech stocks, even worse. So I've got big forecasts, big changes coming in stocks, big changes in real estate. And of course, real estate is what hurts the average person and hurts the economy more, because most people don't borrow money. Traders do, but most people don't borrow money to buy stocks, but they do borrow money to buy real estate. So it backs up on the banks. Your banks have severe exposure to this real estate bubbles. These bubbles are not going to go down 10 or 20% like standard economists are saying. It is going to be at least 30, 40, and probably 50 to 60% in a lot of cities in Australia. This is going to hurt. You are going to have a recession because of this. You didn't have one in the GFC last time. So bold forecast for stocks, a lot of money still to be made, and then get the hell out, because that first crash will very likely be, on average, 42% in the first 2 to 3 months. You'll get whacked right off the bat. Real estate will continue to slide and lead this whole downturn. It will take longer to bottom, longer to go down. But again, it's going to be a substantial downturn, and it will affect your banks. So you don't have a government debt problem. You don't have a demographic problem like most countries in the developed world. You do have a big real estate and banking problem, and you will feel this one. So again, I'm going to spend a lot of time with you. I mean, I tell people, it really takes a couple hours for me to really get out all of my stuff so people can trust that it makes sense. And it does make sense. And everything I project, I track with the past and back up with real statistics. No theories here. So you're going to be able to see, and I think this is going to be a good timing. I think the markets are finally correcting, the stock markets, and I think this is going to be a setup to buy stocks for just a quick run. I mean, imagine if the NASDAQ goes down to 7,000 or a little bit lower and then runs up to 10,000 in a matter of months. Bitcoin, I'm going to hold back on that one. I'm going to have a surprise forecast for Bitcoin. If stocks bubble again, Bitcoin is a slam dunk to do it, and it's going to be huge. Last time it went up from 1,300 to 20,000 in 7 months. So again, exciting stuff on the upside, and then a grueling downside. This is what I call the crash of a lifetime. On this 90-year cycle and in this winter season, we've had a bubble because of the 90-year cycle and all this money printing. We've had a bubble even in a deflationary depression season, which normally wouldn't be the case, but it is in this case. And what we've done, instead of having the worst of the Great Depression early on, as we had in the early 30s, with aftershocks like in the late 30s and early 40s, we're going to see the worst on the far end. We had a real downturn 2008 and 9, but the worst of it's going to come, by my forecast, between late 2019 or early 2020 and late 2022 for the stock market. It's going to take longer than that for real estate to bottom, and the economy probably won't start coming out of it in most countries till about 2023. And then Australia, India, and Southeast Asia will lead the global boom. U.S. will do good, but not great. Europe is going to lag. The East Asian countries, Japan, Korea, all of those are going to severely lag as well. So the world, the other thing I'm going to focus on in this presentation, where do you invest? How do you protect yourself? Especially hedge. Nothing cheaper than hedging stocks at the top of a bubble when nobody thinks it can go down and there's been no volatility on the downside. So you can hedge if you don't want to sell and get out cheaply. But where do you invest when the crash hits? Because that's the secret. That's how you make a fortune in a short period of time, like Joe Kennedy or the mafia did in the Great Depression, or General Motors as a business. The businesses that hunker down and focus are going to survive, because some businesses are going to survive in every sector, and they will inherit more market share in the next few years than any time in the boom, and it'll pay off for decades like it did for General Motors in the 30s. So huge opportunities, but only if you see this coming, and that's why I'm going to beat you to death with data when I come to Australia. And by the way, here's the dates. Auckland, April 24th. Perth, April 26th, Adelaide, April 28th, Melbourne, April 30th, Sydney, May 1st. Let me see, Brisbane, May 2nd. And then I fly back with my jet lag. So again, if people have any questions, I'm glad Martin or myself You got the two best experts right here on what's going to happen. I guarantee you that you will not find better analysis than the combination of what I and Martin do. Again, because we're both dedicated to the truth, objective analysis, no bias towards, oh, I'm a bullish guy or I'm a bearish guy. If you're not a bullish and a bearish person, then you don't understand cycles. You don't understand the economy. And this is the biggest cycle, biggest bubble we've seen in history. And China is the epicenter of it. So with that, I will stop speaking, and then we can have questions with Martin and I, or Martin and I can talk, whatever works out best here.
Great. Thanks, Harry. Good show. And I just want to pick up a couple of your points, and then I've got a whole bunch of questions that people put through, and I'm sure there'll be others coming up too. But I want to just focus on one point that you made, which was, I think, that I've been seeing, that real estate moving down is ahead of the stock market by 1 to 2 years typically, right? And in fact, if you go back in history, that's consistent, right? Why is that? What is the connection between those two events?
Well, one of the things is that, in the spending cycle, which I'll also go through in depth, I'm going to show you cradle to grave where people spend money. And that means even in a downturn, there's going to be areas that are growing. Nursing homes are going to be the biggest single trend in real estate coming ahead, and nobody's going to see that coming. People think baby boomers are already in nursing homes. No, they're just starting to enter nursing homes. So cradle to grave. Real estate peaks earlier in the cycle, around age 41 to 42 versus overall spending at 46. So real estate tends to peak. Real estate peaked in 1925 in the roaring 20s, 5 years ahead of the stock market. And this time it's more like, 2 or 3 years. So real estate is more sensitive to debt and debt service and things like that. Real estate, people will feel a real estate bubble much faster than they will a stock bubbles. Most people have more of their net worth, especially you Australians and New Zealanders. You have more of your net worth in real estate than you do in stocks. So that's another reason. So, but that hasn't always, that's the case, particularly in these fall bubble booms like the roaring 20s and the 90s and now. And again, I have an indicator I'll show you, which actually I think it's 26 months in the US, the home construction index. And that's in other words, the volume of homes built, not just prices. That leads the stock market in the US 26 months, and that seems to be about the same thing happening in Australia.
Yeah, well, we're certainly seeing the construction sector. So new construction approvals are down. The number of construction jobs is falling off now. We've also got, of course, the Opal Tower, which was the very pristine new construction that was actually finished about 3 or 4 months ago in Olympic Park, and is now proved to be perhaps a little flawed from a construction standpoint. So that's putting more downward pressure on the construction sector. So you can see all of these things effectively coalescing, but it's interesting how it looks to me as though it's the property sector that triggers, then the construction sector, and then of course the broader economy and the stock market. Harry, the other question I was going to ask you was, do you think the Fed is going to just print and print and print to try and keep the US momentum for longer? In other words, could this disrupt your cycle, or do you think they're just swimming against the stream and eventually they'll fail?
Well, that is the $1 trillion question, because of course central banks are going to want to double down and print even more. My question is, because people aren't stupid. People see all this money printing and they know it's like a something for nothing policy, but it seems to work. And people are saying, well, maybe it works. Maybe the government did the right thing. It's never the right thing to print money and distort the economy for 9 years. For 1 year of quantitative easing could have made sense, so the banking system didn't just totally fall apart. Give some liquidity, but to have it on, to print $13 trillion over 9 years, it just totally distorts, creates bubbles. So economists keep saying, oh, the problem is inflation. No, the problem is not inflation. This money printing is going into bubbles. So when these bubbles burst, remember what I just said, the first whack, if this is like any other bubble in history, is going to be 42% Sometime the one in 1929 was 49% in 2.3 months. When you get a whack like that, it happens so hard, then people start getting scared, and then things reacting. And then if real estate's going down and they see stocks crash like that, it's going to go down more. And then banks are in trouble, and on and on and on. I think that the Fed will not have, I think central banks will have lost a lot of credibility if they printed all this money, said everything's okay, and then we end up going into a deeper stock crash and real estate crash and downturn. I think my first assumption is they're going to lose credibility, and people are going to say, well, what are you going to do now, you idiots? You're going to create $50 trillion since 13 wasn't enough? 13 trillion? I mean, Japan has printed over 100% of its GDP. Europe's 42%. US is only, I think, 26. We're the best house in a bad neighborhood. But I think they lose credibility. And if they don't, this thing, I think, breaks down fast enough. So by the time they do, you're already going to be in deep trouble in real estate. I mean, we already had a 54% stock crash in the US, and real estate was down 34% before they turned on, the quantitative easing and did all this. So they're certainly not going to be able to just reverse suddenly. The central banks are kind of slow. They don't want to look. The first thing, if the central banks, which they're already doing in the U.S., start to back off, and then people say, oh, they must think the economy's weak. So it's a tough game to play. I think they lose credibility, and or they're just not. They don't react fast enough, and this thing melts down because they've just. This bubble makes the earlier ones look like nothing, and this bubble in Japan. That's the other thing. What can the Fed or the ECB or the Bank of England or all these other, and Japan, what can they do if China's real estate meltdown happens? What can they do against that? And with 75% of Chinese network, they're not going to have defaults because people put much more money down in China. They're going to see the biggest evaporation of wealth in all history. This happened to the Japanese in the late 80s, early 90s. They had the real estate bubble. They leveraged those profits to then go invest around the world, Rockefeller Center and all this stuff in California and Pebble Beach and stuff. And then they had to sell that real estate at a loss in the crash. So there's nothing we can do about the China bubble. We can stimulate our own economies, but China blows, but you're going to feel it. The world's going to feel it. That's going to be like an elephant falling over, as I describe it. So I think this gets away from the central banks. And again, I show another thing. I'm going to show you debt around the world. We have about 300 trillion. That's $1 trillion, 4 times global GDP. 300 trillion in financial assets, loans, bonds, stocks, things that collapse when bubbles collapse. Wealth is going to be destroyed, and debt is going to be restructured and destroyed and just disappear. I mean, it would take, I'm estimating $100 to $120 trillion of financial assets will disappear, just like magic. You create magic and then boom, it disappears. That's the way I see it happen. So you'd have to print $100 trillion to really offset this bubble burst. I don't think they get away with that. I don't think they have enough credibility to print that much, but we shall see. But I tell you, you're going to have to protect yourself from a serious real estate crash, and that first stock crash is going to happen before anybody reacts. I mark my words on that one. So there's going to be a lot you need to protect yourself from, regardless of how this works out.
Yeah, and of course the other point to make is that the MMT brigade, which is quite active over there and it's beginning to get active over here, is going to say just keep printing. I'm just going to go to one or two of the questions. There's quite a few that have come up, but Paul asked about the length of the deflation period that we're heading into. He sort of says that many experts expect the inflation period, deflation to be quite low, and then it's going to kick up quite quickly. I think you may have a different view, though.
Well, I see this as the reverse of the Great Depression. We had 25% unemployment, 89% stock crash. Real estate, by the way, back then was only down 26% because that was not the crux of the bubble. It was more farms going bad and regional, in rural banks than money center banks and suburban urban homes and stuff. But we had the big crash up front, and then you had an aftershock in 37, 38 with 18% unemployment and a 40, 50% stock crash. I think it's the reverse now. We had our 54% stock crash in the US and many markets around the world. And your markets went down as much or more than we did, not because of a recession, but because your markets were overvalued. We're doing even better because of your strong growth and demographics. So we get the big crash on the back end, and I think you go right into reforms. I think central banks do lose credibility. I think that the Great Depression will take about 3 years to play out, but we're going to get the worst on the backside, and then it's going to start to be over, and we're going to start to come out of it. It is possible, especially on this 90-year cycle, that we may stretch longer, but my best estimate is that stock markets are going to bottom by late 2022, and the economy in most countries are going to bottom by 2023, and we start to pull out of this, which means we're just going to get a lot of deflation. We only got a little deflation in 2008, 9, 10. I think we're going to get a lot of deflation fast, a lot of debt deleveraging, bubbles burst. And bubbles, the whole 89% greatest crash in history took less than 3 years to bottom. It peaked in September 1929 and bottomed in July 1932, less than 3 years. So this thing peaks around late this year, very early next year. I'm looking for peak as early as September in this bubble and as late as January of next year. And so a little less than 3 years, we should see an 80, 90% crash by mid to late 2022. And I think this thing will largely be over. And I think reforms will come very quickly when people realize, oh gosh, you can't just print your way, you can't just wave a magic wand and make a depression and $300 trillion of debt, be neutralized. You can't do it. You got to pay the piper. So that, I think this thing right now, I would guess that we see the worst by late 2022. The stock market. It will take longer for real estate to shake out. Real estate in the US last time peaked in early 2006 and bottomed in around late 2012. It took a good 6 years for real estate to shake down.
Okay. Harry, one of the key questions that several people have asked is your view on gold. I think you may have changed your perspective a little bit on that. But clearly, in the context of deflation, in the context of asset annihilation, is gold more or less important in your strategy now?
I'm not quite as bearish, but I'm still bearish. Gold and real estate are the two assets that correlate with inflation. If you adjust gold for inflation, there is no appreciation long-term. When you adjust real estate long-term for inflation rates, there is no appreciation. The difference is real estate you can rent out or you can save rent through a mortgage. So real estate does have a return to it, but it's more the income from rental. Gold has nothing. Gold does not appreciate other than inflation. It is a hedge, therefore, against inflation, and gold has always boomed and bust with the 30-year commodity cycle. It's another cycle ahead. This clock-like. I mean, commodities peaked in 1949 to 51, a kind of a double peak, 1920, 1980, and then now 2008, and the next one is due for 2038 to 40. Gold and commodities peak together. Gold went up 7.7 times in its bubble, more than stocks. And people and all these Peter Schiff and gold bugs say, oh, Harry, bubbles everywhere. Bubble. I said, well, what about gold, you idiots? Gold was a bubble, and gold has burst. I called the gold bubble burst, especially when it broke 1525 in 2013, when Japan started tripling their money printing and inflation didn't go up even with that. And gold said, oh, man, not what we expected. Gold was expecting inflation to come out of money printing. So gold collapsed. But I have bubbles models, which I'll show you for real estate, commodities, and stocks. And the only two things that have not followed the bubble model on the way down to the extent of the crash have been gold and Bitcoin. Those two things have crashed. Bitcoin 85%, gold, has been down, I don't know, 40 some percent. I'm seeing gold now. My target for gold used to be $250 to $400. Now is $700. I think the 2008 lows, the crash there when gold did go down, when Lehman Brothers melted down and stuff, and gold realized, it's a deflationary downturn, not an inflation. We're not getting inflation from money printing, so increasingly. But my target is now $700, and that could be a good place to buy a couple years from now. Most commodities have already seen the bubble burst I'm talking about. It's the only sector. Iron ore has been down 80%. Australia's largest export. Commodity index overall has been down 70 at worst. Oil's been down 80%. Gold's been down 40. So gold has been the best commodity, but it's still an inflation hedge, not a deflation hedge. And I think when the economy goes down, gold will go down further. But target is $700 instead of $250 to $400. That's a big difference. So gold holds up better, but it's still a bad place to be. And then if gold does go down there, let's say we're in 2022 and commodities have crashed more and stocks are down 80, 90%, everything I'm saying happened, real estate's down 30, 40, 50, and gold's like at $700, then gold's going to be a great place to buy. There's going to be another commodity bubble, especially when the emerging world is the big driving factor in the global economy instead of the developed world, because emerging countries are both the biggest commodity exporters typically, and they're the biggest consumers of commodities. They spend much more of their income on commodities than affluent countries like Australia and the United States and Europe. So gold, I'm still bearish on. I predicted this rally. I said at 1,050, it's way oversold. It's going to go to somewhere towards 1,400, and then it's going to start crashing again. It may have already peaked. I would already be getting out of gold if people hadn't already gotten out. And of course, we got people out of gold and silver in late April 2008, right near the top day on silver, and gold topped a few months later than that. But we've been getting people out, but I know people don't sell gold. Hardest thing for me to talk people out of, Martin, is gold and real estate and Bitcoin. So bearish on gold, but could be a great buy a few years from now.
Okay, and we're running out of time, but one last quick question for you. A number of people asked about where should they put their cash? They've got cash in the bank. Should they keep it in the bank? Should they keep it in Australia? Should they move it overseas? I mean, all of those, we can't give specific advice, but have you got any general thoughts in terms of what to do with cash and whether, in fact, the Aussie dollar is a good bet or a bad bet?
I do. That the U.S. dollar was the only major currency that went up in 2008 at the worst of the crisis. It's the safe haven, not gold. Damn it. I have to keep telling gold bugs this. And simply because we're the best house in a bad neighborhood. We've had far less money printing than Japan and Europe and the other major countries. We have way less of a debt problem and real estate bubble than China, and on and on and on and on. So I think for people, when I talk to people in Australia or Canada or the UK, which are my other kind of popular markets, and South Korea and East Asia, I say, hey, you guys have a double advantage. What does well in deflation, and here is the problem with deflation, and this is where I have to tell economists and financial advisors that I'm sorry, you're just going to be wrong on this time. Normally, you could be diversified and do okay. When bubbles burst, when the fall bubble boom season ends, there's this great reset, and that's the best thing to call it. Financial assets reset at pre-bubble prices. So everything goes down. In the 1930s, in the last winter season, the only investments that did well consistently from 1930 to 1941 in the downturn, when stocks were crashing and real estate and commodities and everything else, high quality bonds, U.S. Treasury bonds, long-term, and AAA corporate bonds, the highest quality. And yes, I think the Australian dollar could end up at 60 something instead of 70 something and go down some more. So you're best to have your money in safe, high quality U.S. bonds if possible. And you can do some Australian too, but maybe shorter term duration and stuff. But U.S. bonds are really the best place to park money until stocks and commodities and gold and real estate go down long enough to be strong long-term buys again, say late 2022 for stocks and commodities and stuff. So high quality bonds is the best place to park money, or just be in cash. Now, if you're putting money in cash or high quality bonds, have it in a brokerage account. Do not have any more money than you need to pay your bills in a normal checking or saving account, because that's the stuff where money can disappear. Banks make loans against that for real estate, especially. And when these loans go bad, your deposits can disappear. There can be runs on banks. That's what happens. So if you have your money in a brokerage account in your own name and in safe cash-like or high-quality bond assets, then that money should be safe, and they can't lend against that. And they do, they're committing fraud. So have it in a brokerage account. Maybe split it in a number of brokerage accounts among different financial institutions in case some of them get in real trouble, because financial institutions are going to be the crux of this problem, especially in Australia. Your banks and financial institutions are going to feel this the most. Your commodity exporters have already been crucified. So the next hit really comes to the financial institutions. So you don't want to have your money exposed to their debt and their liabilities. So have it in a brokerage account and have it in safe stuff.
Harry, thank you very much for that. I think that's very good advice to end the show.
Hey, real quick, Martin, quick. I just want to remind everybody, Martin is going to be sending you guys a free gift. So look in your emails for that, in the coming days.
Yeah, thanks, Harry. So there are a bunch of other questions we couldn't get through, including a very intriguing one about why is sunspots important. But unfortunately, people will have to hear you when you're here in Australia to learn about how sunspots play into the various cycles that you talk about. But Harry, I've really appreciated your time today. I think you've underscored some very important points. You've made some new ones. I've seen the feedback on the chat is extremely positive. So that augurs very well for your trip down here. I look forward to catching up with you when you're down here, even if you're jet lagged. And I think the message is buckle in. The next few months is going to be an interesting ride.
Yes.
Thank you. Take care.
Thanks, everybody.
Thanks, everybody, for watching. See you later. Bye.